Welcome to Debt Matters. For too long, I think business loans have been seen through this really narrow lens, sort of as a last resort, right? Something you only turn to when the cash reserves are dry. We want to push past that today and show how external financing is really a strategic, powerful financial tool.
That's exactly it. Our goal here is to really just extract the essential knowledge, to help you understand precisely how these loans add real value to a business's balance sheet. We're moving beyond the whole idea of debt as just a Band-Aid
Right.
and looking at it for what it is, purchased capability.
And our focus is going to be on that tactical use of capital. We're going to examine how these loans are applied strategically, from funding huge asset purchases that can transform a company's output all the way down to just stabilizing daily operations.
It's really about making sure a business can operate on a timeline that's dictated by opportunity, by growth potential, instead of being constantly held back by the slow churn of internal cash. Debt, when it's managed properly, is an accelerator.
Okay, so let's unpack that first and, I'd argue, most common strategic use. Utilizing debt for scaling the business. This goes way beyond just survival. This is about establishing a competitive advantage and fast. When a company gets access to a big loan, what's the immediate capability they gain? What sets them apart?
They gain speed.
Speed.
Yeah, immediate capital access translates directly into operational capability. I mean, think about a manufacturer. Getting a large term loan lets them buy specialized equipment right away. A state-of-the-art CNC machine, maybe a fully automated packaging line, things that could cost millions.
Things they could never save up for quickly.
Exactly. They can deploy this tech immediately, which dramatically increases their output, reduces their unit costs, or improves quality. Waiting 2 or 3 years to self-fund that purchase means 2 or 3 years of lost market share.
That speed factor is so crucial. Let's use a real-world scenario. Let's say a software startup lands a massive enterprise contract. But to fulfill it, they need to upgrade their server infrastructure and hire a dozen specialized engineers, like right now. External funding makes that possible. It makes that opportunity actionable.
Exactly. And if you look at the financials behind that, this funding is supporting long-term asset acquisition. We're talking about assets with a lifespan that goes way beyond the repayment schedule. The equipment or infrastructure they buy, it generates revenue right away, which often far, far surpasses the monthly debt servicing cost.
It pays for itself.
It should, yes. This ability to modernize and just keep investing in infrastructure is what prevents stagnation. It's how you keep pace.
But, okay, accessing capital that quickly has to carry some risk.
Right.
When does that speed become reckless? I mean, a large loan comes with strict debt covenants, right? Sometimes limiting future borrowing or even dividend payouts.
That is the pivotal question. It's what separates strategic borrowing from impulsive borrowing. Responsible firms, they perform really rigorous due diligence. They look at the projected return on investment, the ROI, and they model out stress scenarios.
So they plan for the worst case.
They have to. And they negotiate those debt covenants very carefully. For example, if they expect rapid growth, they might negotiate looser requirements on their current ratio or set up staggered drawdowns instead of taking the full lump sum all at once.
So it's not just about getting the check. It's about structuring the money flow and the terms to protect your agility down the line.
That's absolutely right. I mean, the alternative is that slow, organic growth that's dictated entirely by retained earnings, and that often means you miss your market window completely.
Which is arguably the biggest financial cost of all.
Without a doubt.
Okay, so from that high-stakes world of multi-million-dollar assets, let's zoom in on the operational reality. Let's talk about working capital. Even very successful businesses have uneven cash flow. It could be seasonality, long vendor lead times, or that lag in accounts receivable. How do business loans, say a revolving line of credit, act as a stability mechanism here?
Yeah, this brings us to continuous operational liquidity. Most large businesses operate with a pretty big gap in their working capital cycle. They might pay their vendors in 30 days, and payroll is biweekly, but they're big clients.
Yeah.
They might take 60 or even 90 days to pay an invoice.
Right.
A working capital loan or a line of credit is designed specifically to bridge that financing gap.
So it's basically a financial shock absorber.
Good way to put it.
It just lets you maintain momentum. Like a retailer needing to buy all their holiday inventory now in July to get ready for November and December. If they had to wait for their own cash reserves to build up, they'd miss the buying cycle entirely.
Precisely. And in more complex situations, these loans can mitigate risk with international trade. If you're paying foreign suppliers in a volatile currency, a line of credit, an LOC ensures you can pay them right away, secure better pricing, and keep those relationships strong.
Instead of waiting for slow domestic payments to clear.
Right. It just ensures operational consistency.
And what does that consistency translate to on the financial statements?
Well, it improves your key liquidity metrics. Having access to that working capital cushion helps you maintain a stronger current ratio and quick ratio.
And that signals reliability to future investors or creditors.
Stability is paramount. An internal benefit of this liquidity is that you avoid those negative operational spirals. If you can't pay your suppliers on time, you lose your early payment discounts. If you delay payroll, you damage morale, you lose people. These soft costs very quickly become hard financial losses that dwarf the actual cost of borrowing. The loan is buying you continuity.
So stability isn't just a feeling of security. It's about actively optimizing your operational costs and protecting those intangible assets, like your reputation and vendor trust.
That's the strategic view, yes. You're using external funds to smooth out your internal variability. You're turning potential chaos into predictable expense management.
All right, moving to our final area. Let's talk about how the actual structure of a loan can improve a company's financial health, even without injecting new cash for growth. I'm thinking specifically about debt optimization strategies.
This is where things get very powerful. The strategic use of loans for debt consolidation or refinancing. A lot of businesses, especially early on, they rack up this mixed bag of debt. Vendor financing at high rates, short-term debt with penalties, or, and this is a big one, high-cost financing like factoring or merchant cash advances.
Oh yeah, those merchant cash advance rates can be brutal once you calculate the effective APR.
They can be absolutely punishing. So strategic refinancing lets a business replace that scattered, expensive portfolio with a single structured loan, something that carries a much lower weighted average cost of capital.
And that immediately improves cash flow.
Instantly. It reduces your total monthly outflow, and it just simplifies your financial management.
Okay, that makes sense for cost management. But let's get into a specific structural benefit that's often misunderstood: interest deductibility. For our listeners, we need to go beyond just saying interest is deductible. How does that really impact the net cost of the loan?
This is a critical piece of the puzzle. Because the interest you pay on a business loan is fully deductible as an operating expense, it lowers the company's taxable income. So to calculate the true cost of the loan, you have to factor in that tax saving.
Okay, so if a company is paying, say, a 5% interest rate, and they're in a 25% corporate tax bracket, the effective net cost of that borrowing is not actually 5%.
Exactly. The tax shield effectively means the government is subsidizing a portion of your interest expense. If the tax rate is 25%, that 5% rate really only costs the company about 3.75% after you account for the deduction.
Wow.
And that dramatically alters the calculation for the ROI you need to justify the debt. If the potential return on your investment is 8% and your true cost of debt is 3.75%, well, that spread is highly attractive.
That reframes debt completely. It goes from being a simple cost to a powerful lever for efficiency and, frankly, for tax planning.
It forces you to look at debt not as a fixed cost, but as an input whose net cost is highly dependent on your tax strategy and efficient financial structuring.
Okay, so quick summary for you. We've seen how strategic business loans are accelerators for growth, enabling that immediate asset acquisition. They're stabilizers, ensuring operational continuity through tough cash flow cycles, and they are powerful optimizers for your existing financial costs through refinancing and these key tax advantages like interest deductibility.
And look, knowledge is most valuable when it's understood and then applied. Strategic borrowing transforms a loan from what might feel like a temporary fix into a proactive management tool that drives both efficiency and expansion. By structuring debt, effectively understanding the covenants, the true net cost, and the timing, you maximize its benefits while intelligently minimizing the risk.
So a final thought for you to explore on your own. If we agree that a loan's potential return on investment clearly exceeds its actual cost, after you've rigorously accounted for interest, tax deductions, and all that increased efficiency, what non-financial barriers, maybe things related to risk aversion or even internal politics, still cause so many successful businesses to hesitate leveraging debt for necessary profitable expansion? Something to consider as you evaluate the next move for your own balance sheet.